Welcome back. Today we're talking about Warren Buffett's investments in Japan. He talked about them in his annual letter to shareholders. He listed the 5 companies. This is them: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Forgive me on the pronunciation. I'm probably going to butcher them for the rest of the video. He gave kind of a justification as to why they bought them, how they bought them, and what he likes about them. They started buying it back in 2019, so I'm a little late to this, right? But, he just wrote about it. But their cost basis is roughly 1.6 trillion Japanese yen, and the year-ending value in 2023 was close to 3 trillion, all right? So that should be close to 90%. 100% gain, so 2.9 divided by 1.6. Oh, I'm sorry, I'm just terrible at math. 80% gain. So it should be an 80% gain on the investment, right? But instead, they're only about at 61% because of the way that the yen moved against the dollar, right? We're going to go over that in a second. I just want to show you some things that he said about the companies, right? So they follow shareholder-friendly policies that are much superior to those customarily practiced in the U.S., and since we began our Japanese purchase, each of them have reduced the number of outstanding shares at attractive prices. So they're buying back shares, and they're very shareholder friendly. So my plan is to kind of do a deep dive into these 5 companies' financials. And if nothing else, I want you to see what kind of good shareholder friendly policies look like. And don't take my word for it, take Warren Buffett's word for it. So we're going to get into that. But one example is that management is far less aggressive about their own compensation than is typical in the United States. Okay, so they're not giving their executives ridiculous packages, that sort of thing. I'm telling you, I've seen these companies recently that are paying like 25% of operating cash flow in the form of stock-based compensation and stuff. And I just don't know how the shareholders put up with that, but it is what it is. And they're also paying dividends, so we'll get to that. He does mention that he thinks all of them are very similar to Berkshire itself. So let me get that comment. Each of which operates in a highly diversified manner, somewhat similar to the way Berkshire itself is run. Okay, so these are all big conglomerate, mostly manufacturing companies. I'm not going to spend that much time on what each one does. We're going to focus more on the financials, specifically seeing if they're still good investments, right? Even though Berkshire's up 60% on them. All right, so to start, I want to talk about the Japanese yen versus the dollar. So one of the reasons why their return was lower was because in that time frame, the yen really decreased in value. So it took more Japanese yen to equal $1. It went from being about 100 yen to $1 to 147. What they did, which was super clever, is in order to mitigate this risk, they actually bought the shares using Japanese debt. So they took out loans in Japanese yen with US dollars so that if the yen devalued, now even though their companies are devalued, now they owe less money, less dollars to pay back the Japanese loan. So super smart option on their part to kind of hedge against predicting currencies. I don't really think we have that luxury. But the good news is, if it goes down, meaning if the yen increases compared to the dollar, then these investments will probably go up on a dollar basis, right? So, just keep that in mind. So you might benefit on the other way around because, we're not going to be able to hedge, but it might work the other way for us if we were to buy now. So that's just kind of my thoughts. Okay, so let's go to the 5 companies. I have them here on a watch list in Seeking Alpha. There is a link to a Seeking Alpha deal. They're doing a spring sale or something. They have a very good commission model for that helps the channel. So if you want to support the channel, if you don't have a Seeking Alpha membership, that's one way to help the channel, okay? Anyway, what I like to do with companies is, especially like if I'm looking at one company in relation to its competitors and stuff, I'll put them on one watch list and then go to something like the valuation page. And, real quick, PE, trailing 12 months. You can just look real quick at this. So, we're looking at, most of them are at a reasonable PE. Sure, you have a 12 here and a 14 here. But the other ones, PE's under 8, under 10. So, running from 7 to 8-ish. Now, what's really interesting, though, is that these companies, even the ones with the high PE, look at their price to free cash flow. So this, to me, is super impressive. A lot of companies you'll see, they have, even the ones with low PEs, then you go look at the cash flow, and the cash flow is low, and you're like, what the heck's going on? How are you making no cash, but you have this big income, right? So what really matters to me is cash. So to see that the price to free cash flows are more favorable than the PEs, that's a very good sign. Also, look at this book values here. Look at that. They're all under 2. You got at least one of them under 1, and then a lot of them around 1.2. So anyway, that's just a quick screening. What we're going to do is go through each one's financials and kind of like I said, show you what good looks like, see if we can pick a favorite, and see if any of them look like a good investment opportunity. All right, Itochu Corporation, first on the list. Let's take a look at their financials. So I'm going to start with the cash flow just because I think that's what's most important, and I think that it's impressive too. So look at this cash from operations recently. Okay, so going back to 2020, they've been above $6.5 billion, as high as $8 billion, right? This is all in dollars, by the way, so just keep that in mind. So $8 billion a year. Down a little bit now, but let's just say that they get back up to that $7 billion cash from operations, and then they're CapExing about 1 to 1.5. So let's split the difference and do 7 minus 1.3. So I have the big calculator today. So 7 minus 1.3 is about a $5.7 billion in free cash flow, right? That's how you'd calculate free cash flow, cash from operations minus CapEx. And then to get a free cash flow yield, you divide that by the market cap, and it's about a 9.5%. It's 9.5% return on or 9.5% free cash flow yield. What I think is so neat about these companies, and this is going to be a common theme, is this cash from financing. So I love looking at cash from financing. I think it's a great way to judge how shareholder friendly a company is. So if they're spending money here, if you see a negative here, it means that they're either paying dividends, repurchasing stock, or paying down debt, all right? So, and I usually like to look at net debt repaid because you got to be careful because sometimes there's debt issued, debt repaid, so you got to look at the net. But anyway, the real thing that matters is the net financing going out, right? Because that's going to sum up how much debt they're paying down, how much money they're spending buying back shares, and the dividends, right? So it's kind of like what's the return coming to you, the shareholder. You can see that's like higher than our 5.7 that we calculate, or it's sometimes it's higher, but really this is super impressive. Now, one caveat, if a company's investing in marketable securities, of course that's also good for you, but that will be in the investing cash flow. So just keep that in mind. But anyway, you're getting a lot of that cash back from a financing perspective, right? Or that they're spending a lot in the financing cash flow. Okay. All right, so for the balance sheet, I'm gonna look at just real quick. We're gonna look at their total assets versus total liabilities. So 102 total assets, and then total liabilities 61. So their book value basically 100 minus 60. So their book value is $40 billion, and they're selling for 60. So that's where that 60 divided by 40. It's about a 1.5 price to book value. But what's interesting is, that's great for a giant company like this to have such a good balance sheet. I mean, current assets, $41 billion. So they have $41 billion of assets of current assets and only $17 billion of long-term debt. Anyway, that's Itochu. We're gonna come back to it maybe at the end, but I want to kind of run through all of them real quick. So what's the next one on the list? Marubeni. It is a $27 billion market cap. Okay, $27 billion market cap. Look at this. Oh no, that's gross profit. For some reason, I thought I was looking at net income. I was like, that's really high. Yeah, operating income about a 10x. I'm gonna stick to looking at cash flow and balance sheet for all of them just to save time. All right, so cash from operations, anywhere from 2.5 to 4.5. So we'll say 3.5, right? So 3.5, and then CapExing about $1 billion. So 3.5 minus 1 is 2.5. I don't need my big calculator to do that. Divided by 27 for the market cap, and it's also about a 9% free cash flow yield. All right. Financing cash flow, similar story, although recently it seems like they haven't been, returning as much, except look at this. They've been repurchasing a lot of stocks recently. I know I skimmed over it, but for Itochu, the repurchases were pretty low compared to like dividends and other things. So it is nice to see that the big chunk of change here is in repurchases. I'm going to look at their balance sheet real quick. All right. Total assets, 60 billion. Total liabilities, 37. So that's $23 billion. close to PB of 1, and once again, their current assets, 27 billion compared to total liabilities of 37 and total debt of 12. So again, more current assets than all your debt. It's just, this is really what good looks like between the cash flow and the balance sheet, right? So far, honestly, I feel like these two are pretty similar, and they're not super cheap. Like these don't jump out at me. These just look like solid companies, like solid balance sheet, solid cash flow, but nothing crazy. So let's look at another one. Let's look at Mitsui. Mitsui is a $63 billion market cap right now. And the cash flow here, let's see, cash from operations is, finally one that's freaking growing. Look at that, finally. All the other ones, if you notice, had this like a peak in 2022, and then the 23 and trailing 12 months was lower. Finally, we got one growing. Okay, so this one immediately is like jumped to the top of the list for me. Because growth, I have a whole video on this, but like growth helps you so much in valuation. Like or no growth really hurts you is a better way to put it. But seeing that it's just consistently growing is a really good sign. So this one's already my favorite. So $8 billion in cash from operations, CapExing, let's say 2, and their market cap was 63. So 8 minus 2 divided by 63. Look at that, another 9.5%. Then maybe this is why Buffett couldn't pick between them, because he was just like, oh, these all look about the same. I'll just buy the basket. Anyway, and look at this financing cash flow. Really strong and growing too. I mean, this one, same as the cash flow. I mean, it's just going up and up. Turning $6.6 billion in financing cash flow. And look, a lot of it's been repurchases. So you're pretty much getting, it's like they're splitting it. They're splitting it between third. 1/3 dividends, 1/3 repurchases, 1/3 debt pay down, I guess. So really good there. Let's see the balance sheet. If it's any different. I think that there's a total equity. I don't need to do the math. Total equity, $50 billion on a $63 billion stock. So their price to book, 1.2. And then if I look at current assets, $41 billion versus all their debt is 27. Again, more current assets than debt. Like the one thing that makes this one stand out to me is growth. So that could mean, like, just going back to the cash flow, if they're growing, let's say cash from operations, they went from 7 to 8, 7 to 8 in 2 years. Okay, so to get that in a compounded growth rate, 8 divided by 7 raised to the 1/2, 7% growth rate. Okay, so let's do that for 3 years. So 3 years from now, it could be at $9.7 billion of cash from operations. Let's say you're still paying $2 billion in CapEx. This one could be, easily, I don't know, what would that be worth? Free cash flow, $7.7 billion a year. Probably worth like an $80 billion company, right? So, I mean, this one's got more upside, I'm thinking, just because of the growth. Now, if you put a 15 PE on this, or a 15 price per free cash flow, if you put that on any of these, all of a sudden the valuation gets very favorable. I'm just trying to keep the same PE and say, which one is going to be growing, right? All right. Let's look at number 4 on the list. Number 4, Mitsubishi. This is the one that is most familiar to me. I think everybody knows Mitsubishi. I think that they're just more ubiquitous in the United States. All right, $88 billion market cap. It's also got the highest one-year return, so my guess is that this one's going to be the least attractive, just because it's the most well-known, so it's probably got a little higher price tag on it. Again, though, look at this. I mean, yeah, we had a big spike here, but coming back down, it could be as low as $8 billion, $8.5 billion on cash from operations, and then CapExing 3.5. So that would put you at a 5. Well, okay, am I being too harsh? 9, 8.5, 14, 10. Let's say it drops to 9.5, and then you're CapExing 3.5. So 9.5 minus 3.5 is 6, and then your market cap was what, 88 billion. So this one's a little bit of a lower yield. I don't think it's a bad company. I think it's solid like the other ones, but I'm not gonna. I don't think it's the cheapest by far. So it wouldn't be my pick for the current prices, right? Maybe later. But we're not gonna pay attention to it right now. All right. Last one, Sumitomo. All right, we have a warning on the portfolio. Sumitomo is at high risk of cutting its dividend. Let's see why. What does Seeking Alpha say? Warning signs. Total downward revisions. Okay, I don't care what people say. That's like analysts revises their estimates downward. I don't care about that. Growth rate. So they did cut the dividend a little bit. And this one says they have a lot of debt to EBITDA. Okay, we'll look at that. Let's go back. Sumitomo. This one is a $28 billion market cap, and the dividend yield is 3.6%. So, all right, $28 billion market cap. Let's start with let's start with the cash flow on this one. All right. Let's see. Cash from operations. Kind of all over the place, huh? A trough here, 22, 23, 3.5. Oh, but only CapExing 500. So 3.5 minus a half is 3. And then divide, what did I just do? No, what am I? 3.5 minus a half is 3. There we go. Okay, divided by 28. This is our first free cash flow yield above 10%, right? So, hooray. Anyway, cash from financing. Another one these all, they just look so similar. It's like, hey, we're making a lot of free cash flow. We're sending most of the free cash flow out in financing, so that's good. And balance sheet on this one, I think this was the one that had a PB less than 1. So let's go look. Total equity, 30 billion. Yeah, so it's a $28 billion market cap. So this one has a PB less than 1. And it has total current assets of $36 billion and total debt of 17. So they have more current assets than twice their debt. Just crazy. Anyway, this one's good, but to me it's just the same as the other ones, as the other 3. So let's go back to the list. I'm gonna give my kind of closing thoughts. All right. Closing thoughts are, all of these are solid. I could see why he invested in these, and I think it's a good example of what good looks like, just to see that good balance sheet, good cash flow, and by good balance sheet, I mean low debt and a lot of current assets compared to how much debt you have. And for good cash flow, I mean, shareholder friendly, being they're returning a lot to it in shareholders and stock buybacks and dividends, right? So I see why Buffett bought them. I think my least favorite, just because I think it's run up the most and it's the most expensive, my least favorite is probably Mitsubishi. Mitsui was the one that had the growth. So if you made me buy one right now, I'd probably buy that one. But that's just my thoughts. I don't think any of them are so cheap right now that, I'm like dying to buy it or whatever. But I think if not, like I said before, if nothing else, it's a good exercise in what good looks like. Anyway, I hope you enjoyed the video. Like, comment, subscribe. Tell me what you want to see next. I'll see you next time.